When you target millennials, when you target high net worth individuals, you notice a tendency from their side to be constantly exploratory.
Achha.
They will never be happy with one app or one service. They will keep hopping around from one service provider to another. Early on, we used to use metrics like monthly active users and things like that. But one of the things we realized is in our specific segment of users, that metric does not always give you the right picture.
Mm-hmm.
We do see a high churn in the first, say, 3 months or so, and then they cross a hump. So they start typically with small amounts of money. And what we've noticed is a pattern where people come in, they make micro savings or micro investments, and then they sell it. The only thing they want to see is the full cycle, that how quickly does that money go back to their account. So we have a settlement mechanism of 30 seconds.
Hi everyone, welcome to the latest episode of Goalteller's podcast series where we get senior fintech founders to discuss about their own life journeys with investment, successes, failures, and about their entrepreneurship journey also. So in this episode I would like to welcome a good friend of mine, a batchmate of mine in school, Saustav Chakravarti. Saustav is the founder at Shipley and he dons many hats. Right from advising people on their investments in terms of UHNIs, HNIs. I think Saustav is extremely well placed to advise users on how different stratas of society invest, what are the common mistakes across all of them, what are the mistakes which people do differently, finally what are the learnings from these. So thanks Saustav for being part of this. I'm very excited to have you on part of the show with your vantage perspective of things. So, Saustav, for our listeners, would you like to give us a quick background about yourself, your journey over the last 2 decades?
Sure, so happy to be here. Thanks for having me here. As you know, straight out of college, I went into a corporate life, working for the last almost 2 decades now. Started my career with MetLife, moved on to Citibank. I was also there in HDFC in between. Also been into entrepreneurship way back from 2007. Shipley is my fourth company. Started off with a wealth management firm, moved on to a peer-to-peer lending company, then moved on to an investment advisory and financial planning platform, and then finally Shipley was born about 2.5 years back. This year we are turning 3.
And could you tell us more about Shipley and your last round of funds, the number of users you got on that platform?
Sure. So over the last 2 years, or rather 2.5 years, we now manage around 6.5 million customers.
Wow.
We're generating close to $4 million in terms of annual revenues. We've helped our users save close to 500 crores in terms of savings.
Why don't we start with your Shipley venture? And it's a very interesting piece of information that our users can get access to, because most of the TV channels, most of the mainstream media, social media that you see are filled with stories about retail investments, how they lose money, etc. But there is very few things being said about the average white-collared worker, maybe a Swiggy delivery boy or a Uber taxi driver. How do these people invest? What are the common mistakes do these people make? Unfortunately, in my own experience, I've seen these are the segment of people who lose the maximum amount of money by bad investments like chit funds or lending to their friends and family. This is the strata of society which has not benefited from this entire economic boom and equity markets doing well. What are the common mistakes that you've seen? How you've improved on them? What's the best thing, if at all, there is of this strata which the highest strata can adopt? So please give us some insights on how this segment of society invests and thinks about investments.
Sure. So to start off with, contrary to popular belief, these people are still pretty much hand to mouth. Yes, their income levels have changed a lot in the last, say, 5 years to 10 years. Before that, they were probably content with about 6,000 to 10,000 rupees of monthly income. Today, a Zepto delivery boy or an Uber driver, all of them are earning in excess of about 25,000-30,000 a month. But one thing has not changed is their disposable income, right? Because with increasing income, lifestyle costs have gone up. They all, have smartphones. They are living in tier 1 cities, though they've come from smaller places. They are all migrants, but because they come and stay with us, there are pressures of lifestyle that they have to maintain, and because of that they end up spending a lot. So disposable income as such has not changed. You're right in terms of they fall prey to a lot of scrupulous investment avenues, a lot of unregulated and unorganized chits, where the foreman just disappears overnight, usually is a problem. One thing I think firmly I believe in is, of course, in India we've been speaking a lot about financial inclusion, but I think there's still a lot of lip service. There's not enough inclusion on the ground, and one of the things that we're trying to do at Sipli is to push forward the agenda of equity inclusion. So, India is now poised to be a $5 trillion economy, but look around, do you see any drivers or delivery boys benefiting from India becoming a $5 trillion economy? They don't. Because there's a lack of awareness. They don't understand what equity is all about. Of course, Amphi has done a lot of awareness building around mutual fund Sahi Hai.
And do you think this campaign has also reached to this strata of society?
Absolutely, because they absorb a lot of content on their phone. They are playing on the phone, transacting on the phone. So they're constantly bombarded with ads and campaigns, and also everybody knows mutual fund sahi hai.
Achha.
But कौन सा mutual fund सही है और कब सही है, कितना डालना है, किधर डालना है? These are the questions nobody is answering for them. So equity inclusion is all about democratization. So one of the things we do at Sipli is democratize. So we have an excellent product called Chota Stock, where what it does is, for an amount as small as 100 rupees, we've created a basket of the top 20 stocks of Nifty, and that's available at 100 rupees. So even an Uber guy or a Swiggy guy or a Zepto guy or an office security guard or a housekeeping staff or even your, let's say, plumber or carpenter or gardener can basically go and pick up for 100 rupees, they can own a piece of India. And you're buying the top 20 stocks of the country. I mean, for the country to progress, there is no way that the top 20 companies will not progress.
But how do you treat this investment versus the mutual fund, which also has a fairly reasonably investment, minimum amount that you require?
Yes, unfortunate thing is the entry barrier. You see, many mutual funds still require, at the time of the first setup, they still require a 5,000 rupee minimum or a 1,000 rupee minimum.
Right.
You can maybe after that top up in multiples of hundreds, but that too, how many funds are available at 100? Very few. So because of that initial entry barrier, right, 5,000, you're talking about guys whose maybe monthly savings is about 1,000 rupees or 500 rupees, and they're not going to put all that money into one channel or one avenue.
Interesting.
So the starting problem is where they get stuck.
Very insightful. And demographics of this user base, I mean, are these guys, most of these guys are married, unmarried, and do they have insurances for them? Because I've seen a lot of people in this strata, especially, one medical emergency away from being bankrupt or being under huge loans for years and years. So any thoughts or people you've come across in your experience with Sipli?
Oh, I did. So I think recently there was a regulation which required all gig workers to also have compulsory insurance. And I think that was a game changer because these people never benefited. And like you rightly identified, COVID was one of those black swan events, right? Imagine a delivery boy whose sole source of income is the daily amount that he earns by delivering stuff. And if he's compelled to stay 15 days at home because, let's say, he's contracted COVID and this is his mandatory quarantine period and he's confined to home. So that's a definitive loss of income. How do you expect? So it's not that there just needs to be a calamity for these people to get into the brink of bankruptcy. It is even a small event like just having a disease. And these people are always on two-wheelers. In fact, Bangalore, where we both are based, you will find a lot of people always driving on the wrong side of the road because they have to deliver stuff within 10 minutes, right? And they go and hit something and next 10 days, man has a fracture. So even that 10 days of...
Do you see more people requesting or inquiring about insurance products now since 2 years back?
Oh yes. So we have a loss of income pay. We have accidental insurance.
How do you cater to these guys?
So we've again created very, very sachet-sized products.
Okay.
I remember reading an article where one of the phenomenal success factors behind FMCG products, especially products like daily use products like shampoos and toothpastes, is their offering of sachet size. So Sunsilk, for example, was
Right, yes.
they created these 1 rupee sachets.
Yes.
And that actually enables adoption at a ground level
Yes.
because cash flow is a problem for them.
Yes.
They don't have money to buy a tub.
So in insurance, what is that you have done which is different from what we usually see? What is this sachet size in insurance that you have created for Simply users?
Sure. So we've created a product where for an amount as small as 30 rupees a month, 30 rupees a month is
Wow.
literally a rupee a
Okay,
day.
yes.
And for 30 rupees a month, you get what we call as a loss of income coverage, where if you contract any kind of disease and you're confined to home and you
Anything.
cannot travel, or you cannot go to work, you're reimbursed about 500 rupees per day for a maximum period of 15 days.
Okay.
Right? Now, 500 rupees per day for 15 days is pretty good, and you're getting that coverage for only 30 rupees a month.
Okay.
So that's how we kind of democratize and
And
make it
how
very small.
soon does this money come to these guys? Because of course, unlike other people, they cannot wait because they're living hand to mouth. So how soon is this money disbursed to them? And what is there live cases where you can confirm that yes, this insurance pays off immediately?
Yes, of course. So, for instance, on our app, we do have cases where there's a user journey where through which they have to submit certain documents. Typically, it's a medical certificate followed by a diagnosis of the disease or the problem and a likely treatment plan and how long that person is expected to be off. And if it's anything less than that 15 days, they get reimbursement for those many days. And it's usually a 2-day process to pay out. And it's anything more than 15 days, then they get only paid out for those 15 days.
Interesting.
But whatever they get is helpful to them, right?
Just a very brief understanding about the demographics of your user base, the age patterns, the whether they are married, not married, and there's a reason why I ask you this is because the minute the decision of starting a family and all that is this constrained because of their finances, and post they take a family, how do they continue to be hand to mouth because of extra burdens, and is there anything in future that can get them financial freedom to a certain extent?
Honestly speaking, I don't think these people are even remotely looking for financial freedom.
Now let's go to little specifics. One of the best traits of these guys that you don't find anywhere else. What's that one trait that you have come across?
I would have to say wholeheartedly it's loyalty. When you target millennials, when you target high net worth individuals, when you target even mass affluent people, you notice a tendency from their side to be constantly exploratory.
Achha.
They will never be happy with one app or one service. They will keep hopping around from one service provider to another. They will try out a bunch of different things. They will spread themselves out too thin. And they are very feature hungry. They will look for something here, something there, something new, exciting animation somewhere, a good customer journey somewhere. That excites them. With this sort of people whom we cater at Simply, it's all about loyalty. So a person who comes on board and if they like the value that we are offering, they are happy to just remain, with us. Because first and foremost, they don't have the financial ability to have too many explorations. They don't have money to spread around.
Right.
Second is their mobiles are not like ours. They are slightly outdated. They are slightly, inexpensive. So the real estate on the mobile is limited. So they can't just keep downloading too many apps and things like that. So if you do the JTBD, which is the job to be done, if you just do that well enough for them, they're extremely happy and they're happy to stick with you for a long period of time.
Very
So loyalty is something which is...
And do they continue their investments even in bad times and good times, or do you see a lot of pauses?
We see a lot of pauses. So one of the metrics we actually... Early on, we used to use metrics like monthly active users and things like that. But one of the things we realized is in our specific segment of users, that metric does not always give you the right picture. Because their income levels are volatile, their income sources are volatile, and therefore their savings behavior is very erratic. What matters is that as long as Simply remains a top of the mind for them, whenever they have money, we want them to come back and save on our platform. So as long as we are able to accomplish that, whether they come back every month or every quarter, it's irrelevant.
And do you see a lot of churn in them in terms of them trying to exit the investments they've done, or they are fairly long term, or do they need to be taught about what long term is?
Yes, definitely to a certain extent we need to teach them about what long term is or what's the minimum expected duration that they should spend once they've got started with an investment. We do see a high churn in the first say 3 months or so, and then they cross a hump. The moment they cross a hump, we get to a certain very stable retention graph over a longer period of time.
Okay.
So the initial drop off is quite steep, then it reaches a zone of stability, and then sometimes it peaks up after a longer period of time
And
when people come back.
this drop off is in terms of incremental investments or actually exiting the existing ones?
Combination of both. Some of them even exit,
Okay.
and we kind of relate that to a cash flow situation.
Okay. And what do they exit completely lock, stock and barrel, or they have a preference of, let's say, not exiting gold because it might be close to them, or is there any pattern that you see amongst them?
Yeah, so gold they don't exit because I believe in all likelihood they are not buying gold as an investment,
Okay.
but they are buying gold more from a consumption. They want to gift it to their wife or sister.
And
or
they're
daughter.
okay gifting digital gold. That kind of adoption has happened.
So the way we've pitched gold to our user base is that we start them with digital gold, but the premise is that whenever you want, you get to convert that into physical gold.
Okay.
So what attracts them is the physical gold because they
Right.
want to hold it in their hand. That's what gives the tangibility to the
So
product.
do they trust the digital gold? Because until they see the gold in their hands, are they comfortable seeing it digitally?
So they start typically with small amounts of money,
Okay.
right? And that's where making it micro, making it 1 rupee, 2 rupee, 5 rupees, 10 rupees actually helps. And what we've noticed is a pattern where people come in, they make micro savings or micro investments, and then they sell it. The only thing they want to see is the full cycle, that how quickly does that money go back to their account. So we have a settlement mechanism of 30 seconds. So
Okay.
if you sell gold on our platform, within 30 seconds, the money is back in your bank account,
Wow.
right? Through, IMPS credit. And if you've given your UPI handle, we directly send it to your UPI.
Okay,
So you
wonderful.
need not even expose your bank account, for instance. Once that couple of transactions
Got it,
happens,
got it.
then they commit a larger amount.
Larger amount.
Then
Okay.
they stick.
So equities, of course, by nature of it is very lumpy. And a lot of these individuals might be used to seeing linear returns in their investments. So how are these guys adapting to the volatility and lumpiness of equity returns?
So we see a clear pattern of early adopters versus fly-by-night users. So early adopters essentially, I think either by design or by intuition or by their own intelligence or understanding, or they're able to grasp certain things. Once they make an investment, which they have over the last 1 year, they've seen ups and downs, and they continue to save in the hope that A, all of this will recover, B, they know markets go through up and down, and they will eventually make money, and C, they kind of top up also in between because they know if it's something is down, I should buy
Oh,
more,
very interesting.
right? But that's only a handful of people, right? Let's
What
say
percentage?
10%.
10%. Okay.
90% people, they've come in because they've been swayed by some influencer somewhere, not by us, but by some other influencer, because there's a lot of these get rich quick schemes out there, right?
Yes.
So they think stock market, and to a certain extent they've been swayed by all crypto buzz also,
Yes,
where they've
yes.
seen, you put 100 and in a month it becomes 1,000 and all
And
that.
yesterday, incidentally, SEBI has clamped down on YouTubers
Exactly.
and fined, in fact, well-known personality Arshad Varshi has also been fined. As you're
Correct.
aware.
Correct.
Okay, so fair enough. So, Saustav, coming to my next question, an extension of the earlier one, is tell us one incident where one of these users or workers of yours have come back and thanked you for what you've done, and in one case where they have actually been very critical about this whole experience.
Sure. So when we started our gold product, I remember the gold price was about 5,500 per gram, in that range.
Yes.
There was a gentleman, he's a security guard in one of the factories from which we had onboarded the employer. Clear expectation that he wanted to save money over a period of time and get that gold converted to a coin and then give that coin to his family. He got fired. He urgently needed access to money. So he came to us, all of this happened, of course, digitally. He sold it. By then, the price of gold had come down. It had come down to about, I think, 4,800 per gram or something like that.
Correct.
This gentleman was very, very vocal about losing money. So it took us a while for us to explain to him that at the end of the day, gold is not an investment, it's consumption. You're looking for that 1 gram of gold. How does it matter whether that 1 gram of gold is 4,800 or 5,400?
And did this incident make a detriment to him in meeting that financial goal that he wanted, or his expenses management in the time he was out of job? Or did he manage?
Yeah, he got the money back, of course.
But at a 10% cut.
At a 10% cut, and that's what upset him a lot.
Yes.
It took us a while to explain.
Okay.
And before that, on our app, we used to show the daily price of gold. Now we stopped doing that because we realized people are not buying gold to track the price of gold. People are buying gold because they want to gift it in some festival. India is a land of festivals, 23 festivals. So there's always something around the corner where you need, and there are a lot of these auspicious moments when people buy gold.
Got it.
And the usual thing is you target a gram of gold, or you target a value of gold in terms of grams, not in terms of the actual money.
And how many people percentage-wise convert the digital gold to actual physical gold?
So anybody who spends more than 6 months on our platform.
But what percentage would this be out of the total people who buy digital gold through your platform? What are the percentage of people who are converting it to physical
gold?
Yes.
It's almost 70%.
Wow.
Right.
And this 70% is people who cross 6 months, or the entire basket?
No, 70% is people who cross 6 months.
Okay, so anybody who crosses 6 months, 70% of that segment surely converts to physical gold.
Will take physical gold.
Okay, very interesting. Now, the other side of it, tell us one incident where someone has been thrilled with your experience, has come and really thanked you about inculcating the savings experience or returns or whatever it could be.
Sure. So one of the recent innovations we've done is we've launched a digital chit. Chit, as you rightly identified when we started, is a space where a lot of people have lost money. Phenomenal number of frauds or misappropriations, and it's usually focused on the chit foreman running away with the money, and or if it's someone in your friend or family who's running an unlicensed chit, they run away, and things like that. So about a year back, we took a call saying let's digitize this space, because there's almost a 90% penetration within our user base within this product called Chit Fund. So we said if we have to really make a dent on inclusion, or the whole concept of democratizing or digitizing financial services for this 40 crore population, we said we cannot avoid or neglect a product like Chit Fund.
Sure.
So let's digitize it completely, and we launched India's first digital chit. In fact, we acquired the only other digital chit company in the country last month.
Right.
So now collectively we are the only ones out there.
And what are the contours of this product in terms of returns? How soon you can get the money in case of a distressful situation?
Sure. So typically, I'll tell you, if you look at all the other major players out there, so you look at Shriram, Margadarshi, KSFE, MSIL, Gokulam, Kapila, there's a whole bunch of them. All of them are non-digital. They're all branch-based.
Branch-based, yes.
They're all paper-based,
physical.
One thing we have to realize is a chit is not just a savings product. It's also a borrowing product. See, how a chit works is in a group of 25 people, all 25 people save every month, one person borrows. Next month again 25 people save, a different person borrows. Now the person who's borrowing is borrowing at, let's say, an interest rate of about 13 to 14% annualized per annum, which is definitely superior than getting a money lender lend to you. But the important thing is they need to get that money on time. If you look at all the other players, from the time you win the auction to actually getting money in your account, it takes 2 to 3 weeks, somewhere even upwards of a month. So we realize that if a person is coming to us with a requirement for money, they need to get access to credit fast. So that's where my positive story is. So there's this gentleman whose mother fell down in their home, and she had to be rushed to the hospital, and she had a fracture of the hip. And, unfortunately, you know how hospitals are.
Right.
They do not tend to admit people from, let's say, a lower strata of society unless you're able to cough up an immediate amount of a security deposit.
Okay.
So he was asked for a 10,000 rupee deposit just to admit her into the hospital, which he didn't have.
Sorry for one related question here. The government's insurance scheme that has come about, is there traction building up on that scheme?
Not much, because awareness is not there.
People are not taking that scheme, you're saying, not registering
They're not
and enrolling
aware.
for that
They're
scheme.
not aware.
They're not aware. Okay, interesting. Okay, sorry to cut you out. Yes.
So he needed that money, and he applied for the chit auction, right? One of the core philosophies we built our platform on is transparency. So he applied for the auction, and the auction was in another 2 days around the corner. He applied for an auction, and we disbursed the money to that gentleman within 24 hours. So the beauty of our platform is any chit auction, anybody wins, within 24 hours the money is in their account.
Okay.
So typically from 2 to 3 weeks or a month, we brought it down to 24 hours, and we are now setting up mechanisms where we can even bring it down to 30 seconds.
And how do you ensure this guy continues to be there and doesn't run away with that money? And that's the biggest problem with chits, right?
That's the biggest problem with chits. So that's where insane amount of underwriting goes in. All digital, of course. But luckily today we have those mechanisms. You can pretty much check the social profile of a user. You can check their bank records. You can check their vintage in the company. You can check Aadhaar address. You can verify their current residential address through a utility bill. We look for government guarantors.
But most
we look
of these
at
will be
e-match.
migrant workers. So a lot of these things like utility bills and all that will be fairly redundant in their cases, right?
There's either an and or there's an or. So there are a lot of operators there, and we, combined, we need to get to a satisfactory risk profile, and then we are comfortable to lend
And
to that person.
the percentage of NPAs or people who run off
Is less than 1%.
Wow.
Yeah. So
It's amazing because you don't have any physical security.
we don't have
right?
any physical security. Yeah.
Okay. Interesting.
And one thing I think that has changed drastically for this segment of people is their awareness of credit.
Okay.
Because see, at the end of the day, we operate in micro chits. Our chit starts from 1,000 rupees a month, which is the lowest in the country. So typically, a lot of data is available online, eNACH and things like that. And NPA is about less than 1%. So one of the
That's
things we've seen
incredible.
in this segment is gratitude. If you help them out when they need, they really are okay to come back and pay. And since we operate in the space of micro chits, only once in the country to offer 1,000 rupees monthly chit, the chit value is only 15-20,000. So these people today are very conscious of credit and credit score. So they don't want to mess up their credit score for an
Does
outstanding.
this impact the credit score? So this microchip, does it go into their credit report?
It does go into CIBIL.
It does?
Yes.
And
Yes.
which category? Is this a new category or?
So a chit fund today comes under the MNBFC regulations, which is miscellaneous NBFC.
Okay.
So a default here also gets reported to.
Okay. So then in the credit score, it will show a loan from SIPLI. Is that right?
Not exactly, from the chit provider.
From
So
the chit provider.
we are an agent of the chit
Or
provider.
you are only an intermediary right now.
Correct.
So you do your due diligence with the chit providers.
Correct.
Okay. Do you think these chit funds can also be an investment vehicle for retail, affluent, mass affluent or HNIs in the future?
Yes, absolutely. So chit actually is a fine balance between a borrower and a lender. In fact, chit is the original antecedent of what we now refer to as a peer-to-peer lending platform.
Right.
Because chit is nothing but peer-to-peer
Yes, yes.
lending. So while say about 60 to 70% of the users come in with a mindset to borrow, there is also 30-40% of the users who come in with a mindset of only saving. And a saving person in a chit is typically one who just puts money every month, but who takes money right at the end.
of it. Okay.
So they have a positive ROI between 8 to 9% per annum, which is superior to a bank rate of interest or.
But of course, the risk is much higher. I guess the delta here should be higher.
No, not exactly. So the risk is underwritten by the chit fund company.
Okay.
So the foreman assumes the risk of the default. Unlike a P2P where the lender is taking the risk of the loan, in a chit platform, the foreman takes up the risk of the
But
the
despite
defaults.
that, do you think this 2-3% delta is enough to commensurate for the liquidity gap or whatever little risk which is there?
So typically, chit, I would say it offers value to those users who have an uncertainty of cash flow. For instance, if you are absolutely certain that you will not need money for the next 24 months, then you are probably better off putting that money into a recurring deposit. But there also the rate is lesser than what you would earn in
Got
a
it,
chit.
got it.
And I'm sure you'll agree 2 years is too short to do a mutual fund SIP.
Yes.
Right? You may see a negative return. So from that perspective, it sits nicely. But let's say you're one of those people who are fairly confident you will not need money, but you may need money. Then chit is an excellent product because while you're saving, for some, God forbid, eventuality, if you suddenly need money, that money is available to you and you can option.
Okay.
So chit works remarkably well for that strata of society whose cash flows are
A
unpredictable.
little warped, yes.
Yeah.
And also they cannot, so now as we go along, I think we are very confident that corporate bonds will become a big avenue of raising capital by large institutions and also investments, especially with the government's latest regulations about MLDs. I think corporate bonds will be a big area of capital raising. The problem is capital bonds do not have small lots right now. And that's where I think the chit funds will score. Plus added to it the liquidity problems. So thanks, Saustav. I think that was very insightful on SIPLI and the investments and your experience with this strata of society, which most of us do not come across. Now moving on to your experience, maybe you can help our listeners understand your biggest investment mistake and your biggest investment success in the last 2 decades that you've been investing?
Sure. So I think the biggest mistake was back in 2007. Looking at the euphoria in the market, I took out a loan of 5 lakh rupees and I put it into a bunch of stocks.
Wow.
Being supremely confident on one's abilities is something that everybody goes through, or a lot of people go through. At least I went through. So I picked up a very nice collection of large cap stocks. I don't usually delve into mid caps or small caps much. Those I usually invest only through a mutual fund where the fund manager is much better equipped than me. So I picked up large cap, selective ones, which I knew would break out and do, give me a very, very handsome return. I took out the loan and I made that investment around August of 2007, oblivious to the early headwinds that were coming in the US from Lehman and others. 2008, when the crash happened, I kind of lost out on almost 60% of that capital. Stayed put for a while, eventually gave up.
And this 60% was on your invested money or on the leveraged money?
Whatever I invested was leveraged, because till then I was only investing.
So what I meant
through
to say is
mutual
that
funds.
you had 100 rupees of your own capital, and how much did you borrow?
So all of my capital was in mutual funds.
Okay.
And I took out a 5 lakh loan
On
only
your
to get
mutual
it.
funds, so that you invested this. So kind of 1:1.
Yeah.
And on this 5 lakhs, you were down 60%.
Yes.
And you had to pay off these loans.
So I sold off a bunch of my mutual funds to pay off that loan
Okay.
and close my positions.
So effectively, you started with 100 rupees, and so your mutual funds would have also been down 50%. So
Pretty
you
much.
practically lost all your capital because of this leverage.
Exactly.
Okay.
Exactly.
And
And I had to start from scratch again.
scratch again. Okay, that is unfortunate. And so you never do this again, and I presume that has been the biggest learning of your life, as to not take investments and take loans and invest.
Absolutely.
Okay, great. And what has been your biggest investment success?
About 2.5 years back, I started my journey in angel investments.
Okay.
And that's what led to now me running my own angel fund. I think it's very important for us to start taking at least some part of our allocation from our assets into early stage investments. That's where wealth is created. Otherwise, your entire listed experience is, at the fag end of the journey. The wealth creation is already done, both for the founders as well as for the early investors. So I'm trying to democratize the whole access to early stage investments through the angel fund, and that's what Sprint is all about. There, what we are looking at now is again an SIP route, so the angel SIP route, and this goes back to my experience of about 2.5 years. Some of my early stage bets have returned in excess of 15x to 30x in terms of the capital that I've invested.
But you would have had some losses also here. So what
Yes.
would, if you had invested 100 rupees in your unlisted investments, what's the net return you would have seen? And what's the ratio of successes to losses that you have witnessed?
So over the last 2.5 years, I have made 248 investments. These 248 investments, I have seen 4 write-offs as of now, though I admittedly feared that in 2023 that number may go up drastically because a lot of companies are towards the end of their runway or a very short runways, and we don't know. I remember reading an article that 2023 might see a mass level extinction of the startup ecosystem because of the kind of problems we have with venture capital right now. So right now it's 4 out of 248 that have shut. About 36 out of 248 have gone into their first markup where I've seen value appreciation, and the rest are all, they're doing well, but many of them have not raised a follow-on capital. So it's neither a question of markup or a markdown.
But
that's where I'm right now.
There is a possibility that a large portion of this could just be surviving and could go
it
bust.
is.
So yeah, so I think yes, some of these guys who are flat right now, which have not seen any markup or markdown, possibly will go extinct over the next 6-12 months. Assuming that, you would still make a fair amount of return from this entire, initiative of yours, I presume.
Absolutely. So early stage investments, it's a trade-off between risk and reward. I follow a diversified model, and that's the premise on which my angel SIP methodology is also based, where you spread out your bets, have conscious, I would say, decision making on the kind of companies that you want to expose yourself to. There are certain markers that we use. For instance, we don't invest in companies which are not revenue generating. We don't invest in companies in their first round. We generally co-invest with larger institutional players because then we know that the larger institutional player will at least provide a follow-on for the next couple of rounds at least, and of course something disruptive, something which is also impactful, because impact is also something that we look for. Impact doesn't always mean the upliftment of society. Impact also means at a granular level how you can impact a person's life. That's also equally important.
Right.
We're looking at democratizing and going for a
Very
larger pool
interesting.
of investments.
Sure.
So there we are not targeting a 100x or a 50x or a 20x kind of a return. If it happens, that's well and good. It may happen for about 2% of the portfolio. What we are targeting is a very predictable 2 to 3x or 3 to 4x kind of an ROI.
Sure.
Because for first timers who are getting into angel investments, it's important to have a positive outcome rather than having a moonshot outcome.
Sure.
See, if moonshot happens and one of your portfolio becomes a unicorn or a decacorn, that's fantastic. But it rarely happens. It's better to have a very predictable outcome of 3
So
to 4x.
this is not the spray and pray.
This is not a spray and pray.
Excuse me.
It's definitely not a spray and pray.
And what's the minimum allocation percentage and the maximum for any retail or a mass affluent user, do you think? Two questions. So what's the minimum net worth that you think a person should have for exploring this investment asset class, which is unlisted investing? And secondly, what's the percentage of his total financial assets that he should deploy in this asset class?
So, SEBI has regulations around who an accredited investor should be. So, from that perspective, a person needs to have a net worth of at least 2 crores before they even venture out into angel investments. So, it's not for everybody. That's the first
Angel
thing.
investments, as in terms of unlisted equity, I think there is no
Unlisted
barrier.
equity, there is no barrier.
But if they have to opt for your fund.
Yes, because it is at the end of the day a SEBI registered angel fund, right?
Okay.
So there are accreditation norms on the net worth that a person should have. The second thing, of course, which is more of there is of course no guideline on this, there is no regulation on this, but we kind of enforce it, that a person should not expose more than 10 to 15% of their entire investment portfolio
Okay, fair enough.
into early stage investments, because then it gives you the benefit of decoupling the rest of your investments with this. You should always consider this as one of your outliers, but keep the rest of your portfolio stable or steady so that you can fall back on it.
Any learning material online or something that you advise investors to look at? How do they take the plunge with a small amount? Let's say if someone wants to take a plunge with 1 lakh or a couple of lakhs, are there opportunities and avenues on the unlisted side that they can explore?
Absolutely. I think there's ample amount of reading material. There are courses on Udemy or Coursera which talk about how do you actually assess companies, how do you assess ideas, how do you assess if there is a founding team has the recipe for success.
And are these relevant to the Indian context, these courses, or they are very US related?
I would say originally they were very US related, because naturally the ecosystem started
More
there and
thriving
it
there.
evolved to the rest of the world. But today there are a lot of anecdotes, there are a lot of case studies on the Indian startup ecosystem. And in fact, right now I can tell you 2023, the Indian startup ecosystem is much more vibrant and much more, I would say, in demand than West. West has taken a severe beating, has both listed, unlisted, early stage, everything. And a lot of investors globally are now focused on India, because here everything seems to be breaking out of shackles, right? So from that perspective, there's a lot of available material online on
Great.
the Indian startup ecosystem.
No, thank you so much on your comments about the unlisted investment, because that's something which we keep. That's a fancy kind of thing which is there in the mind of investors, that they want to participate in this entire startup boom that is there. Now coming to your own success, non-unlisted investments over the last 15-20 years, is there some specific incident you might want to tell us about investing in common investments, about mutual funds, equities, where you have made money due to certain reasons or certain good decisions?
Sure. So I think one of the good things we had back in the day when I started my career back in 2004 was this very nice ATC deduction, right, or exemption. When I started my career, I was forced to make one of those ATC investments, and I did it in an ELSS fund. If memory serves correct, it was DSP tax saver, right? And I had invested around 70,000 back in 2004, and over the last close to 20 years now, it has delivered more than a 10x return. I think it would have been even more. I believe I may have withdrawn from it in between also,
Sure.
maybe a couple of times. It's one of those forced investments that I was made to do because I had this need to save taxes, which is something that every
Sure.
Indian desires, right? The need to save taxes. And from that perspective, I made that investment. And because there was a lock-in, I remember those days there used to be a lock-in of 5 years.
Yes.
Right, when we started. Now it's 3 years.
3 years.
And what happens is when you make an investment and you don't touch it for 5 years, beyond that you tend to forget about it. Right, and these were not folios that could be tracked online and things like that. I remember I had to fill out a form, give a check, and that's how the investment was made. So by the time I could even look up where the investment was and what it was doing, it was already 10 years plus.
So it was a forced retention of the investment
Forced
which led to
retention.
this success.
Correct.
Because as you're aware that a lot of mutual fund houses have done studies where compounded return of the specific scheme is 18-20% over the last
Sure.
2 decades, but investors have not made more than 10-11% because they keep coming in and out.
Correct.
Okay, very interesting. So has this helped you to make more longer term investments now?
It has. In fact, I am a big proponent of a thought which says that you should not get to see your entire portfolio all the time. Because unfortunate thing is people have there's this syndrome called the trigger finger syndrome, right? Where if you are sitting with a gun, you have this constant urge to press the trigger, right? It's the same thing here as well. When your entire portfolio is in front of you, and with so much of technology advancement, at the click of a button you can get redemptions and all of that, there is this constant need, and you're exposed to so much of content, you're exposed to so much of news, you're exposed to so much of negativity and positivity, and unfortunately negativity happens to be more. There's always more fear all around you, and that is what I think plays a very bad role in getting people to act early and pull out their investments.
Interesting.
So I am a firm believer that if I were to build a technology system which visualizes my entire portfolio, I would love to consciously at the time of setup decide, okay, these are the investments I don't want to ever see. So remove them and hide them somewhere, right? So that if I don't see it, I will not act on it. And that's like kind of putting it forced into a long
But isn't it like a double-edged sword? Because when we see at Goalteller investors' portfolios, we see a lot of bad investments which have been there and languishing because of lack of attention. So, of course, there are some investments which turn out to be very good, but there are many which turn out to be very bad because of lack of attention and they did not pull the plug in time.
Absolutely. So, say this would typically apply to, say, for instance, a large cap oriented fund, or let's say an index fund, or let's say a thematic fund like, let's say, banking or financial services, right? These are all evergreen sectors.
Evergreen. So, one needs to be sure of the fund that all investments are not evergreen, right? So,
absolutely.
the learning is that there are very few investments like index funds or multi-cap or large cap funds which can be left unattended for long periods of time.
Correct.
Fair enough. That's a good takeaway for our learners. Now, Saustav, coming to one more aspect of your life, you have been an entrepreneur a lot of times, and in today's times, we see a lot of people trying to take the plunge towards, having a startup of their own. People are trying to do this even before they have financial freedom, or they are individuals or singles, or even when they're married, before they're having a kid. And if things do not work out, which is more often than not, they are in a very, very precarious position. In fact, maybe many years of their lives just go towards building up that investment saving kitties again. So what has been your experience while you started your startup, and what do you recommend people do before starting something on their own?
So this is something which is very important. You decide to start a business, or you decide to venture out. That's a decision that you're taking to fulfill maybe some aspiration of yours, or you have this burning desire to create an impact or leave a mark or a legacy or something like that. Your family is not making the decision with you. So one thing I always tell my fellow entrepreneurs or founders is ensure that there is an adequate amount of safety net for your family, because entrepreneurship journey is not going to be smooth ship once it starts sailing. It will get into rough seas. When it does, you need to weather it, but not put your family through it as well.
Right.
Because your family deserves some degree of stability, some degree of assurances, some degree of security. And before you take the plunge, it's important that you prepare those securities ahead of time.
Sure.
Because once you've taken the plunge, it's very difficult to kind of latch on to those securities. Or if you don't have them, it's very difficult to prepare them then. Because when you're starting out, you'll probably pay yourself very meagerly. Even if you raise capital from investors, it's unlikely you'll be able to take large salaries. So one needs to kind of set aside a little bit of security for family, and then take a plunge.
So guys, a small tidbit which I would like to give. At Goalteller, we have some thumb rules for people who want to start off on their own. They should have 3 to 6 months of monthly lifestyle expenses set aside in any liquid asset, not in equities. In liquid assets means bank accounts, liquid funds, etc. And any 3-year financial goals that they foresee, this also should be well allocated. If these two conditions are met, they should take the plunge of entrepreneurship. Saustav. So thanks a lot. This also helps. Now coming to the last section of our podcast, any entrepreneurship lessons that you would like to impart to our listeners, because you have seen a very, very wide range of subjects, right from Sipli to your VC investments. You have met a lot of founders yourself. So one piece of advice that you would like to give anyone on VCs, on investing and starting up on their own?
I think one of the most important traits that a person should have, no matter what they do, is of course patience. We cannot work miracles within a short span of time. A lot of businesses make this mistake that when they want to launch something, they expect quick outcomes, whether it be developing the product or coming up with a award-winning design or offering a particular service.
As we come to the close of this very interesting podcast, could you help our listeners with one tip if they have to start on their own, one investment advice, and any one generic advice that you would like to give, any life lesson for our users?
Sure. So one investment advice, of course, is whatever you do, think of it as long term. There's no shortcut to success in life or in money. One entrepreneurship advice is have patience. A product, design, service, feature, customers, funding, nothing can happen overnight. So one needs to commit to the process. Outcome is a part of the process. As long as you commit to it and remain, persistent, results will come. And one life advice is never put anything at a higher priority above family.
Right.
Family is most important. Business may come and business may go, but you will, yourself have your health and your family. So put that, I won't say at a higher priority, but at least at an equal priority to work in business.
Saustav, amongst the different hats that you don, which has been the one that has given you the most joy and something which has made the most impact and which you love doing?
I would say the biggest joy has been getting opportunities to go out there and showcase what we built to whoever, whether it be customers or whether it be investors, because that is when it's like a talent show in your school where your child is going up on stage and the whole world has their eyes on them.
So the baby being born into a grown adult is something that you've enjoyed most.
So any opportunity to showcase your child is a phenomenal opportunity, because then you can stand tall with pride.
Right.
So from that perspective, showcasing in front of customers and investors.
And which has been the best baby for you?
Obviously, there is a lot of attachment to the latest one. I have very fond memories of each of the other 3 businesses that we've built. But we've really put our heart and soul into Sipli at this point in time. So we're really hoping that we get a good outcome for all the various stakeholders that we have.
Thank you so much, Saustav. It was a pleasure having you with us. And I think a lot of insights that you've shared on different subjects has been very, very insightful, very new insights. And I think will be very helpful for everybody. Thank you, Sastav.
Thank you. Pleasure being here.
So, thanks everybody for tuning in to this episode of Goalteller's podcast series. I'm sure a lot of you must be very enlightened with the aspects of Sastav's journey and about the different facets of people he has managed. And thanks, Sastav, a lot for doing this with us. And I would like to present a small token of appreciation from our side
Thank
to
you.
you. Thanks so much.
Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.